Boy, do we have a lot to talk about. The U.S. their debt was downgraded for only the second time in history. Let's talk about the first time back in 2011, what this new debt downgrade means, and frankly, is the U.S. debt truly risk-free as everyone suggests? Perhaps not. Let's talk more about it. But before we get into that, make sure you hit that subscribe button so you're notified. Hit that bell so that you know when videos come out so that you can get the latest content. We try to educate and increase your financial understanding, your ability to make money in markets. So back in 2011, many years ago, the U.S. debt was downgraded for the first time from the S&P credit rating agency. There's three main credit rating agencies: S&P, Moody's, and Fitch. In 2025, Moody's has now stepped in and downgraded U.S. debt. So Fitch is the lone holdout. They haven't downgraded the U.S. debt from AAA rating yet, but they might soon follow. Now, what does this mean for markets? Well, when they downgraded the debt in 2011, markets went into a bit of a tailspin and crisis mode, and it was a big event. I remember it was a chaotic weekend. It was a very tough time. Right at that same period of time, one of my childhood best friends, who was a Navy SEAL Team 6 member, his name was Jason Workman, they were shot down in Afghanistan. And so this was a tough time. We were on our way to the funeral. The funeral was wild. You had to go through checkpoints because, again, SEAL Team 6 had been famous for the Osama bin Laden situation. So they were worried about retaliation to these families and so on. We had to go through checkpoints even to go to the funeral, and it was on, lockdown mode and so forth. But anyway, it was a tough time personally, but the markets were in turmoil. And I just remember, maybe I'm remembering it worse because of the things that were happening in my personal life. But ultimately, the markets did sell off. And if you go back and look at a chart, it was an ugly stock market period. So Moody's on Friday, after the market closed, downgraded the U.S. debt, and the markets budged a little. The futures fell about 1% or so, but not a massive reaction, nothing like 2011. And the question would be why? Why did the markets not react? Well, first of all, they weren't the first to ever do it. So they went to where S&P's rating already was. And we can see from the past 14 years, that the stock market has been fantastic. The stock market has gone up multiples. So obviously the debt downgrade wasn't that big a deal. And I think that's what the market is reacting to, is they say, well, it really didn't derail the stock market and they've gone massively higher. So maybe that doesn't matter. I think it does matter in the grand scheme of things. I think it does matter in that, well, the reasons they're downgrading are valid reasons, that the U.S. is on an unsustainable path. And everybody keeps using that term. It's unsustainable. But we're not doing anything to fix it. And ultimately, if you acquire too much debt, just like any household, if I have way too much debt and I can't pay for those things, well, how do I do it? In the U.S., they might say, well, we can just print more money. The problem with that is we just recently had a massive bout of inflation. The inflation rate went up to nearly 10%, and the Fed didn't even react in time. The inflation rate went to over 7% before the Fed even started to change interest rate policy and to start raising rates and start to try to really get ahead of the inflation. They were way behind. So it's one of those dynamics where we've seen inflation rear its ugly head, and that has created an even bigger wealth gap where the producers, the people like me that own stocks, were fine, but the people that are consumers that are just buying products, well, those products have gone way up in price, and they're just not getting enough income to match that. And I know the Fed is well aware of the inflation risks. You cannot print your way to prosperity. Inflation will get worse, and the risks of, hyperinflation, I think that's a little too big to worry about right now, but it might not be too big to worry about down the road. So we really need to cut back on some of the things, and it might mean that they have to make some tough decisions. You know, the government may have to make some tough decisions. And it's hard for government officials to do that because that doesn't get you elected. You don't get elected by coming out and saying, hey, we're going to cut entitlements. We're going to do this. We're going to do that to create a better balance sheet, to not have trillions of dollars of deficits every year. That's not a warm, fuzzy message, and that does not get you elected, but it might be in the U.S.'s best interest. So I think there's a reason that people like Warren Buffett, who do fundamental analysis, he now has more of his money, Berkshire Hathaway has more of their money in cash than they do in stocks, and they love stocks. There's no bigger cheerleader for stocks than Warren Buffett, and he says, you know what? I'm not seeing the value proposition right here, right now, so we'll wait in cash and we'll wait for a big opportunity. And he talks about that this unsustainability will create some form of a crisis. But having said all that, I think the market is sort of okay to react fine. I don't think that debt downgrade creates a massive problem today, but I would look at it as one more negative domino. I would look at tariffs as just one more negative domino. It's not catastrophic. It doesn't mean that GDP is going to collapse. It doesn't mean that the economy is going to collapse, but it is a negative. Net, it's a negative for the U.S. economy. It slows growth, it hurts corporations, it does some things that probably are not great for earnings growth in the S&P 500. And ultimately, when you're looking at valuations, that hurts the valuation. That makes stocks more expensive, not less. It makes them less attractive, not more. So from the standpoint of opportunity, we've got some risks trickling through in the markets. Now, if the U.S. government debt is downgraded, does that imply that it's truly not risk-free? Because a risk-free asset has to be AAA rated. If there is zero risk of default, well, that's as AAA, that's as perfect as it gets. So if you're downgrading the U.S. debt, are you suggesting that there is at least a tiny percentage chance that the U.S. could default on their debt, that they could actually not have the ability to pay their debts? And that brings up an interesting question, because everything in finance kind of uses the U.S. government debt, this risk-free rate of return, as the baseline. And then if I'm going to take risk, I have to take risk that compensates me, because if the U.S. government will pay me 5%, well, I'm not going to take risks in corporate bonds at 5% or lower. Why would I? I can get risk-free at 5. I've got to be compensated at 7 and at 8. I need to have municipalities pay me more than that. I need to have stocks generate a yield, generate a return that's greater than 5%. So it's the baseline. And if the baseline is not truly risk-free, that changes the mathematics of everything in finance. So it's an interesting debate. It's an interesting long-term issue. It's not a short-term. It's not a problem necessarily this week or next. But over the coming quarters and over the next few years, these are some issues that we're going to be working through. So I'm sure we'll be having more YouTube videos talking about it if and when the dominoes really start to topple over. Right now, we're looking at this from a longer term perspective, and it's just one more negative checkpoint. It's just one more thing that kind of checks that box on the bearish side, not on the bullish. So stay tuned. Make sure you hit that subscribe button. We love you. We continue to share as much education as we can, and we try to make it fun, simple, and real. We'll see you next time.